All of it takes us to our talk of the tape. Whether the 3-month takeoff for stocks still has room to run, and if so, how much? Lots of answers likely coming this week, but let's ask Dan Greenhaus of Solus Alternative Asset Management. He's here with me on set. It's nice to see you again. What's on the line this week between tech earnings, the Fed, jobs reports, and Treasury news? Feels like this is make or break, perhaps?
Yeah, it's a really important week for both the macro and the micro. The Treasury borrowing estimates are out now, which maybe we'll touch on in a second. But before we get into that, let's just take a look back, because I know the premise of the segment is the rally at risk. But when you look at what's happened already, I know obviously there's a lot of focus on the dominance of tech earnings in the context of the larger market. But there's an article in the Wall Street Journal this morning about the strength in retail and how rent concessions have basically gone away. SL Green reported the other day, reported its second consecutive quarter of Manhattan office occupancies moving higher. United Rentals, the leasing company, 13% rental income growth, strength in all end markets. And then you've got all the different card companies. There's a lot of focus on credit metrics from Capital One and Discover. But Visa reported, I own it personally, have for 10 years or whatever, but as a macro indicator, their commentary continues to suggest that they see nothing from the consumer side of things that suggests recent trends are likely to change. Altogether, that's a pretty good backdrop heading into this week.
You're pretty positive? I mean, because even as the market continues to, elevate, theoretically, it just raises the bar, if not the pressure on these companies to deliver what their valuations would suggest they have to, right?
Yeah,
the valuations have been increasing on the idea that these are the ones you can count on.
Yeah, I think that's right. I mean, I don't mean to dismiss the importance of these names or their contribution to either the performance of the market or earnings. But yes, I think there's obviously a lot of focus on these names given their strength. But listen, Microsoft always beats by a couple of percentage points. There's going to be a lot of focus on AI, on Copilot signups, which might become a new metric that we have to follow on a daily basis.
Probably so.
I think that it's not as if these companies are not performing and valuations are expanding. They've done quite well on balance. I mean, obviously, Apple has some trouble in China and at the top line, but on balance as a group, Tesla aside, they've delivered quarter after quarter. And so, as we said and everyone has discussed, they warrant higher valuations, and that's effectively what they've gotten.
So Marko Kolanovic today, just a short time ago from JP Morgan, he's been negative for the last many, many months. And he says today valuations look even more stretched. So how do you sort of take that view? Look at that. A few bad inflation prints would likely upset both bond and equity markets as risk markets, could again start pricing in the higher probability of a hard landing. What do you make of that argument? Because even somebody who's really bullish, like Jeremy Siegel, says, 20 times is not exactly cheap.
No, it's not. And listen, PEs leave you little room for error. That's true at the single stock level, and it's true at the index level as well. But listen, we came in last year, granted at a lower multiple, thinking EPS this year we're going to be somewhere around, I think it was 225, and then for the next year, which is now this year, we're going to be somewhere around 250. Both those numbers have come down by about $10, let's call it. And obviously the market had a terrific year last year, largely on the back of valuation expansion, which you're unlikely to get this year. But the linkages between valuations and multiples and market performance can be differentiated from one year to the next. But I think what you're saying is entirely true, that when you're trading at 20 plus times forward earnings, you have little room for error. Now, fortunately for the broader market, these companies have quarter after quarter delivered more or less. Now, obviously, Tesla has fallen by the wayside, and Apple has the troubles that we discussed earlier. But fortunately, again, for the market, they've done quite well. Now, listen, is 25, 30, 35 times earnings too much? I mean, that's for the market to decide. But again, fundamentally, I think they've delivered.
What about the speed in which and the strength in which the market has gotten to today? Tony Pasquarello runs hedge fund client coverage, Goldman Sachs, always has thoughtful notes, and I like to read them and let our viewers in on kind of what the conversation is with the big money out there. He's like, this has been one of the most powerful short cycle rallies we've ever seen. For the avoidance of doubt, the 19% rip in the S&P over the past 3 months registers in the 99th percentile of market history. Goes on to say, enjoy it, because it ain't going to last like that.
Well, yeah, so you're not going to go up at this rate ad infinitum. And listen, the market from a relative strength index is classically overbought here. And so you certainly could have, maybe it's the Treasury Department news, although it seems like we're hanging in there right now. So certainly you could have some level of a digestion, although the strength of the rally historically doesn't necessarily automatically mean it. But I don't think Tony makes incorrect points.